Hey everyone, welcome back. We have Sai coming back from Tapp Alpha. Sai, is this our fourth time doing this? Third time? Fourth time?
Yeah, third or fourth time over the last year or so. So it's been awesome getting to know you, and it's been crazy just kind of seeing the interest in the conversations around what's happening in the marketplace. So it's good to be back with you.
Yeah, I mean, we certainly have developed, quite the reputation here. TSPY is like just destroying it. Took a little while to really get it off the ground. And I think once people got comfortable with it, it's been a killer. 154 million in AUM. Congratulations. How does that feel?
Thank you. Unbelievable. It's wild to think. I think before, maybe after we did our first interview. So thinking about like New Year's Day of 2025, total AUM for Tapp Alpha was 13 million. And now with the two funds, 11 and a half months later, I think we're at 213 million. So it's just really, I mean, been an unbelievable ride. And it's been interesting too, in sort of a challenging market environment where, the new administration came in, and then you think about what happened January through April, and April was just this crazy roller coaster rodeo. And then since April, it's sort of been a really good test for overlay strategies and covered call strategies. And the strategy that we've had and the execution has been doing quite well. But like, what a year to sort of come to the market with it. And it's been amazing to sort of see the growth in the AUM.
So let's talk about that. What was your like protective strategy during April? I mean, we fell what, 20% or close to it?
Yeah, I mean, everybody got hurt. So, like, if you think about our funds, it's owning the underlying security. So, in our case with TSPY, it's owning SPY. And then it just does a daily overlay. That's all it does, selling out of the money covered calls every day. So, if you think about the downside risk, like, we're still long the underlying security. So, you're going to take a lot of that downside. The only cushion or, like, hedge against that is really the incremental options premium that you can collect in the prior period. So from January through April 2nd, we added about 200, 220 bips of cushion.
Sure.
But 220 bips of cushion, when you have an 18% drawdown, it's just a small pad, but you still take a lot of the downside. So that's one of the challenges. And then the rodeo happened again. So, like, what's the worst case scenario for a covered call strategy? You take all the downside and then you cap your upside if there's a really fast recovery. And guess what happened on April 9th? Super fast recovery, a historic one, right? It's only happened 3 times since World War II. So that was literally the theory of the worst case scenario for a covered call strategy coming to life. And so we got through that. We captured about 60% of the upside on April 9th, but it still put us behind the underlying index by about 3.8%. And that was like, it was a gut punch, right? It was not fun to go through, but it was a blessing in disguise, because what it did for us is it really helped us harden the strategy. And so I think maybe 8 days later, we updated and amended our prospectus. And we added two tools to help prevent, in really high VIX, high environments where there's a lot of volatility. We added two things. We added ultimately a protective put on the downside, and then a credit spread on the upside for a call spread. So what those are is basically catastrophic insurance to the upside. So if there's a big uprun, you can minimize how much you don't participate. And then on the protective put, you can put a safety net in case there's a big downdraft. And we have some rules on when we put them in. So it's high VIX plus momentum. Is it like momentum up or down? That tells us the occasional places where we may want to use those sort of protective tools. So we added those to the tool belt, and then we fine tuned a lot of the other stuff too. We created like built-in execution into the platform versus external to the platform, which took trade execution from maybe 15 seconds down to milliseconds. And when markets are moving fast, that's a big deal for collecting premium, and also a big deal for putting in the protection that you need. And then the last thing we did, we actually created this sort of X-ray fish finder tool that helps us kind of see the underlying dynamics of the market at different strikes. And that's been a game changer for us too. So since April, if you look at April 11th through now, you can see how it's differentiated us, not only catching back up and exceeding the underlying, but also how we sit in the competitive landscape with other funds that are doing zero DTE strategies.
Gotcha. Okay. So just so the audience is clear, and this is for TSPY, or is this for both TSPY and TDAC?
No, great question. I love that you asked that. So since we have an underlying fintech, everything we learned and codified for TSPY will apply to every future fund that uses the same strategy. So now it's actually all the learnings from April even apply to TDAC.
Okay, so are you looking for to implore these strategies? Are you looking for like a VIX over 20, or like what's your target?
Yeah, 27 or 29, somewhere in there is the ballpark when VIX is elevated. So in April, it was over 30 for 2 weeks. And then on April 9th, it was like 55 to 60. You could feel the powder keg just like ready to blow. And that's kind of when you want to put some insurance in.
Okay, so and just so everyone's clear, you guys, do you own SPY
Mhm.
outright, or is it a synthetic option?
Outright, which is a very important thing for tax efficiency. So we own real shares.
Okay, so you own real shares, and then which gives you the what is it, the 1240 short term, long term? I mean
Oh,
60.
yeah. Yeah, 60/40. So own the real shares, and then we're trading index options, which is 60/40, potentially tax advantage, long term, short term.
Beautiful. Okay. And then you're selling out of the money covered calls
Mhm.
on those. And then when things go haywire, you're going to take a little bit of that premium, and you're either going to buy a put, or you're going to buy, I assume it's an in the money call, right? So you get a little bit of intrinsic value.
Other way, it's an further out of the money call, so it's a safety net on top. Yeah.
Okay. Okay. No, why not? Why not slightly in the money so you get a little bit of intrinsic? Is the cost just too high?
Yeah, cost is very, very high. And so we're trying to get a credit spread. And if we go in the money, then we're actually going to be a net negative versus actually still getting some option premium above and beyond the cost of that purchase.
Now, how does that impact the distributions? I don't want to say the word dividends. I want distributions that you send out on a monthly basis. How do you factor that in?
Yeah, so the option premium itself, when you just do a pure covered call, if it expires out of the money, it's all take home, which gets distributed. But if you're taking a portion of that and then you're spending to buy insurance, that'll reduce the option premium that's collected. And so we try to sort of smooth out like peanut butter the distributions over a year. So the short term sort of I guess volatility, we try and smooth that over time. And in 1 month, if we don't have as much of the option premium, we can fill it from other places. And other months, we may make more from the option premium. So that's kind of our strategy. Is income investors we know really want reliability, and so we try to provide that by smoothing out all the market turbidity or volatility by making it more predictable that way.
Okay. So back to the 60/40 idea. I think it was back in September of 2024 was the first time you and I had talked, and towards December, I think we did another one of these. We had talked about TSPY was going to, instead of giving out all of the distributions, you're going to put some of that back into the NAV because you're generating a little bit of extra premium from the treasuries, just holding on to cash. Are you still going to do that come 2025, or are you going to pay out like a massive dividend for December?
This is the best part about actually owning physical shares. So one of the reasons why, let's go high level. So there's implementations that own physical shares of covered calls. And then there's others that do synthetics, where you don't own physical shares, but you sort of simulate the returns through options. And in many cases, it's 1256 contract options. When you own physical shares, think of it as like a bucket of value. It's a value store that when New Year's Eve comes and January 1st, you can take that bucket and push it forward into the next year. So like if you have a bunch of capital growth in your SPY shares like we did, we don't have to pay that out because we didn't realize those gains. And so the rules for ETFs say, okay, that's cool. If they're unrealized gains, you can carry it forward, which if you're doing a true growth plus income product, that's the growth you want to compound and carry forward. If you're doing 1256 contract, this is where it gets interesting. Because of the ETF rules and the tax rules, on New Year's Eve, the synthesized capital growth in the options contracts has to get sort of like realized. They call it mark to market. And if you're in an ETF, the law says you have to distribute 90+% of your realized gains. So if you have that capital growth in the synthetics, that has to come out to investors in that fiscal year. So sometimes that's why you'll see a big distribution for some of the funds that do synthetic options in December, because they have to, by rule, distribute those gains. So if you're a growth plus income investor and you have a synthetic fund, there is literally almost no way to carry forward capital growth in the ETF. So you just get a high level of income. So what does it mean from a NAV perspective? The very best you can do with a synthetic implementation is 0% NAV change. Mm-hmm. Otherwise, it's always going to be negative. And then you have to reinvest and do all that. That's what I love about this implementation is we actually own shares. And so the growth piece just naturally can carry forward, and then you get your income component over time. So that's when I think one of our biggest differentiators. And by the way, it was not easy to implement that with the banks and the custodians. They really pushed us to do a synthetic, and we just said, no, we don't want to, for lots of reasons. One was like, how do I explain it to my family? And they're like, do I own shares? And they're like, no, you just own options. That's a hard road to hoe. Versus if you own physical shares and they're like, oh, okay, so I own SPY. So if I sell the SPY and buy TSPY, basically I own the same number of SPY shares just wrapped in your ETF. And I'm like, yes. And then we do this thing on top. Much easier to communicate. And in fact, just a much better tax structure too.
Interesting. Okay. So I don't want to put words in your mouth, but basically everyone who's not holding just SPY is kind of getting screwed on this one.
Well, it depends. So like, different investors have different goals. So if you're like a pure income investor where growth isn't important to you, like if maybe you're later in your retirement and like, you're like, I don't need my nest egg to continue to like go up. I just need to start to use that income in a tax efficient way. Great use case for synthetics. Okay. For me, like it's no secret, like I built TSPY selfishly because I wanted to use the product. There was nothing on the market like it. And so that's what I did. Like I've got, I'm late 40s and I have a young family. So I need the nest egg to grow, but I also need income for today to sort of make ends meet. And this was the perfect package to do it. So I just took all my SPY shares that I had owned for a long time, sold those and bought TSPY, and then taking the income every month to sort of make ends meet while I'm building the company. And so I built it for people in this demographic that have the same goals. You need growth plus income. This is the package that worked the best that we could figure out. And so far it's delivering on its promises.
I get into a lot of these heated debates about total return. A lot of people are just getting their face ripped off right now in covered call funds. And they quite grasp the idea that like you do have a capped upside, unless you're going to employ like a strategy like you did, you have a capped upside. And you have 100% downside risk minus the premium that you collect. So when people are getting all of their, I don't want to get into, too into the weeds on the taxes, but when they're getting a lot of return of capital, how much could, I'm sure you might be familiar with the FIRE movement, financial independence, retire early. And the whole thing was like, you're going to live on the 4% rule and never run out of money. If we were to carry that over to the covered call ETFs, that same idea, I was trying to figure out if you're buying, say, TSPY or whatever else is out there, TDAC, how much could you possibly live on? Like, is this something that like I can live on, the covered calls, and that's going to pay my bills, and I have upside? Like, I don't have to worry about the growth, but I don't necessarily need to reinvest. Like I can live on this money. I think it's what, 15% that you guys are paying.
Yeah, 14% for TSPY and about 17 for TDEC.
Is that stable, or should we still go back to say, look, I'm going to live on 5% or 4% of the distributions I collect, reinvest 10%? Have we figured out like a number? Like, what's your thought on that?
Yeah, it's a good question, and actually a good framing for it too. The answer is, unfortunately, it depends on your circumstance. But here's the dynamic piece that we can kind of get into. So the main thing, if you think about it from a high level, you're living on income, but the thing that's actually producing the income, do you want it to shrink, stay flat, or grow over time? And that's kind of the trade-off. So the more you kind of pull out in income, the more it impacts the NAV of the nest egg. So I would say, like, if you don't need all of that income, so we do 14%, we did it for a reason. I'll get into it in a second. If you don't need it all, we're distributing it in a tax efficient way. So you can take, some people like to live on 8. So you take 6 and you put it back in, and then your nest egg itself can grow and compound too, but it's also giving you what you need. But if you need a lot more income, let's say you need all 14%, if you look at TSPY's historic performance, I think in the first year, the market, the S&P was up 17 or 17 and a half, and we distributed 14. So the NAV grew by 3%, and we were able to distribute the 14%. So that was the balance that we chose. And here's the thing. There's two audiences that we really want to try and benefit. One is DIY retail investors. The other audience is advisors. And advisors, in many cases, do not want big distributions. They don't want to manage it. They don't have to reinvest it for their clients. And in a lot of cases, I've gotten requests to say, hey, can you distribute less? And then the retail folks are like, can you distribute more? I need 14. So the way that we actually sort of threaded the needle was, or they actually, sometimes retail investors want 20. We threaded the needle by saying, okay, we'll do 14, but we'll do it tax efficiently. So if you're an advisor and you don't need all 14, you can actually dial it in and take your 8 or 10 and reinvest the rest. So we check that box, and then we check the higher yield box or higher distribution box for retail investors, because they're able to sort of pull out up to 14% if that's what they need. So that was kind of our solution to solve it for both audiences.
So is there really a safe number? Like what would be the percentage you can actually take out and kind of remain flat? You said
so
was a reason. What was the reasoning behind that?
The reason was part of it is sort of historic performance. So here's the thing. We can't say there's a safe number or not, because nobody has a crystal ball to know what the market's going to do in the future. And that is it's the ultimate driver of what the performance of a fund will do. And that's what drives total returns. But for us, we sort of have to make a strategic choice. So we said 14% is kind of the target. We're managing to it. The underlying has delivered more. And this is a really important concept for everybody to understand. NAV erosion and NAV decay, we define it as, here's your total return. And if the fund that is delivering that total return is distributing more than that number, then that money has to come from somewhere, and it's going to come from your NAV, and things will shrink. So how do you create a sustainable product? You try not to, for long periods of time, you don't want to distribute more than your total return number. And that's one of the easiest tools to look at ETFs and products to say, okay, over a year, what was the total return? What was the distribution? And if the distribution is higher, you're probably going to have NAV decay. And that's one of the things that we try to strategically, not experience as NAV decay. So if there's again, no crystal ball, but if into the future the market is flat or goes down, and we can't fill that hole with options premiums, then we have to choose between either sustaining a 14% distribution or decaying NAV. And our strategic choice is, and it's the golden goose theory, we don't want to shrink the nest egg that's going to be providing the income over time. So we're going to have to probably meter down the distribution so we don't over distribute and decay NAV unnecessarily. That's our strategic choice for how we'll likely manage the fund in the event of a big sustained market drawdown where we can't fill the hole with option premiums.
Okay, so during crazy volatility, are you actually you make a killer on on the premiums with the open interest being high? Are you kind of sandbagging that and just taking a little bit of meat off the plate and just saying, I'm going to put this over here, buy the dip so we can capture more of the upside?
That's the peanut butter theory, right? So if you get a lot one month and you don't need it all to hit your number, you scoop it for future months, knowing that you may not always be able to get all that premium, especially like some months VIX is super high, some months it's not. So you just got to smooth it out over time to give that more consistent experience for what we distribute.
So I'm looking at TSPY compared to SPY right now. And I mean, it's like neck and neck. And for anyone at home watching this, I'm using the stock analysis. Neck and neck for total return. It's like, I don't know, it's like a quarter of a percentage point. They're just, going up, which most funds that I've been tracking, especially in the ETF, covered call space, it seems to be that there's this like divergence where the underlier is going up and, the ETF is just kind of slowly starting to go down over time because they're over distributing.
That's a big part of it. And that's the balance that we're trying to really walk, where when we were designing the product and deciding how to like get this idea out to the market, there was just this big hole in the product menu out in the world that there wasn't really a lot of balanced funds. And that's sort of the hole that we wanted to fill. So growth plus income, but like a balanced approach to both, where you're not over focused on, just socking it all away from a growth perspective, but you're not overdrawing from a distribution perspective. And so we actually started by saying, well, we want to do 7% or 8% distribution. And people were like, in the retail community, kind of laughed us off the stage. And they were like, that's not exciting. And we're like, but it's exciting to me. Like, if we can do S&P plus that's pretty awesome. They're like, Luke. So, but we ended up increasing our distribution, but doing it in a tax efficient way so we can make the kind of the retail do-it-yourself community that needs a little bit more able to take it, but then also still satisfy the 8% crowd. And that's why we did what we did with the tax efficient distribution at a higher number.
I've seen a huge movement, and I assume, judging by the NAV, you guys have seen this as well, but by your AUM increasing. I've seen a big movement of investors, especially on social media, kind of going from, these crazy high income, just doing full circle and going back to, we want the TSPYs of the world. We want something that's going to pay out consistently. We can set our clock to it, and it's going to grow, and it's not going to eat our lunch. And I see like this full circle of people in 2025 just coming, and everyone's starting to talk about it again as if it was like a brand new concept. It's like, no, we've been here for like a year and a half now.
I'm super curious too, like out in the communities, what you're hearing and like what's causing the sort of evolution of people to sort of come back around. Is it just education? People are understanding the core concepts a little more, and they're just seeing maybe the longer results of maybe some of the super high yielding funds. Like, what's the driver from your perspective?
People are getting sick of reverse split.
Yep.
And when they get there, especially come 2025, a lot of these funds paid out a lot of money, and everyone gets excited about the high rock, the high return of capital. Seems kind of silly to me, but when they're going to get their 1099 from their broker, and they're going to say, I lost 50% and I got to pay taxes on it, they're going to be really upset. And I think people are starting to wake up to it, that it's not sustainable. And so I kind of laughed at them. Like, everyone's going to go back to Vanguard, or everyone's going to go back to just holding the SPY, because it's really difficult to beat the SPY. I mean, people for 100 years have said, just own the index. Like, that's it.
88% of funds don't outperform the underlying index. They don't outperform the S&P 500. And that was kind of our thesis when we launched the product and kind of did the idea, was like, it's really hard to get alpha in pick stocks. So just buy the index, let that do the work for you, and then add this other capability, which is just a tax efficient overlay, so that you can actually get the index plus a paycheck if that's what you need. And there's some residual other benefits too. And it's very simple to understand because it's just an overlay. You get a little bit lower beta because the overlay is a hedge. It's not leverage. and you get ultimately like a way to get an income stream. You're tapping into the income stream of the underlying S&P, where the S&P only distributes about 1.6%. If you can add, a 14% tax efficient distribution to it, it helps solve a couple problems, but the core exposure is still there. And that was like, so like people that know my story, this was 2022 when I did this in my own individual brokerage account, and markets were down. But if I had to sell my SPY shares in 22, the worst part is I had my chips off the table. I would have missed 2023 and 2024. But I didn't have to. I kept my chips on the table. I got the exposure and I got income that I needed today in order to make ends meet. So like that was the thing that we don't talk about enough, I don't think, is like you still have exposure to the market like opportunity while you're generating income. That was the game changer for my family, because then that really helped us in 22 and or 23 and 24. Plus, we were able to sort of pay the bills in the short term. That was the why behind building the product in the first place.
Yeah, no, absolutely. So tell me about TDAP, because you guys just launched it. Is that on the queues?
Yeah, so it's the same exact strategy. It just switches out SPY and plugs in the queues, and it uses everything that we've already built in place and codified with our fintech, but it just runs the same exact strategy on the queues. And the main difference is simply the implied volatility of the queues is higher, so there's just more option premium to go harvest. And so that's why we were able to sort of sustainably, knock on wood, we can't promise future distributions, but we're distributing about 17% instead of 14. And mathematically, it's kind of like, I love the engineering side of it. The ratio between the distributions is exactly the ratio of the implied volatility of S&P 500 versus the Qs.
And how long ago did you launch that?
September 4th, so just over 3 months. And yeah, take a peek at total returns and kind of where we've been. But you can, to your point of it's hard to beat the underlying index, from September 4th to today, it's really cool if you can, in your video, show the graph, because you can see the divergence of the lines, where TDAC every day is just scooping little bits of premium and adding to the options alpha that you've been able to get over time since we launched.
So, okay, so in the past, I'm going to try to show this on screen. Since September 4th, total return is 7.83%. So, I mean, annualized, that's that's like 28% annualized. I don't know if
and then if you can, add the Qs or the NDX to it as the comparison.
I can do the Qs. Is it QQQ? Is that what it is?
Yeah.
Since 3 years, 3 months.
September 4th is the start date if you can.
So I can only do months, but they both. I'm going to do 3 months, and you're beating the Qs. I don't know if you guys can see that.
Yep.
The total return, you're beating the Qs.
So that's a really cool educational tool, because the difference between the two lines is only the option strategy. That's it. That's just the option premium that we're harvesting on top of capturing the performance of the Qs.
You're beating the Qs by about 1.5% right now since inception, which is phenomenal. Like, I don't think there's another fund out there that does beat the Qs.
There may be one or two, but their strategies are different, and they're also like, we write on 100% of our notional value, and we're still beating, which means that we've been finding a good way to manage it over the last 3 months. No guarantees for future, but like we're really getting fine-tuned on how the strategy is operating on all of the equities that we're overlaying. So we did that on the first two, and every product that we have on the product roadmap coming for next year is going to use the same overlay strategy with the same tools. It's just going to switch out the underlyings as we continue to scale the product roadmap.
Yeah, I think the only thing that you would normally have to be in a super high beta in order to beat the underlying, but that obviously you're subject to massive downside risk as well at the same time.
That's what's really cool about this is covered calls are a hedge. They're not an amplifier. They're not a leverage. So being able to actually get market-like returns with a lower beta, these are advisors, whereas they're like, that's holy grail territory if you can find a consistent way to deliver it. So we're working hard to try and get there, and knock on wood, so far so good.
I want to get your take on this. I keep trying to understand the difference between the psychology between the advisor and the retail trader. So I'll preface this for the audience. Advisors want something that they can count on, that they can go knock on grandma's door and say, hey, you want some income now? Instead of a life insurance policy, we have TDAC. Whereas if, I'm just gonna make up a name. Or is the fund manager, is the advisor going to go, hey, we have this covered call fund, it's going to pay you 120%. You're going to lose everything. It's not a sellable product. And I think what retail fails to understand is, like, you need both retail and the professional side. And if the professional side can't sell it, they're not touching it. So right. Retail is basically holding, the crown of these like crazy high dividend ETFs. They're the ones who are pushing this up and taking the money out. But it's not sustainable because there's it's not even, I don't even want to say it's total return. Like, yeah, premiums generate some income, but it's the flow of money. As money flows in and out of the market, you're going to see the market do this sort of thing. And it's all retail kind of moving the needle, but you're in both buckets. So it's kind of like a nice, steady, even keel along the way. Can you touch on that?
Advisors don't want like crazy up and down. They don't want, advisors' whole lens is like they're risk managers at some extent. And so they want products that they can understand, that they can explain to clients, that don't put the risk picture too high. And one of the analogies that an advisor told me, he lived in LA. He's like, if I'm driving from LA to Vegas and the speed limit's 65 and I can get there in time based on my goals, why do I need to drive 120 miles an hour? Why do I need to risk that kind of danger in order to achieve a goal that I don't really care about and my clients don't care about? So that was their analogy. And that's one of the reasons why the super high risk, high reward stuff, they don't necessarily want to participate in. And then the second is the costs of a lot of those products that are focused on retail that are really up and down. They're over 1%, and advisors won't touch it just because they understand the power of compounding. If you take 1% out every year or 1% in a quarter, and you're not getting the consistent level of returns, it just really erodes your capital, and advisors don't want to do that for their clients.
And what is the management fee, if you don't mind sharing, of your funds?
We're 68 bips for TDAC and TSPY. And so that was sort of the sweet spot where it wasn't super high cost. So there's other 0 DTE funds that are like, oh, we're doing it same day. It's a lot of work, so we got to charge 1%. For us, because we've automated so much of it, it's hyper efficient to implement it from a ETF operations standpoint. So we're able to offer about a 40% lower fee than what some of the competitors are offering.
And that is so massive. I don't think enough people talk about that. And some of these funds, these covered call funds, are charging 2%, and people haven't quite grasped what 2% means in like 10 years. Especially when your NAV is just like falling in the toilet, and they're still collecting 2%. That's money right there.
It's just one of those things where you don't think about it if you're focused on the now. But if there's like an educational resource, like the stuff that you do, if you can shed a light on it and say, okay, let's look at that over 10 years. What does that mean for you? That's when it hits you right between the eyes to know the impact of fees, and then especially the impact of NAV erosion and decay, because that power of compounding when you have time is the most powerful force in finance. And so how do you actually use it to your advantage instead of your disadvantage?
No, that's great. I got a couple questions for you.
Yeah, sure.
This one comes from Screeching Possum. I love the name. Would be curious if TSPY has any more specific time frames when they plan on launching their weekly funds. I didn't know.
Great question. Yeah, so one of the things that we can't talk about because we're in a blackout period right now is that the timelines for the next funds that come out. But just here's what I recommend: sign up for our newsletter at TappAlphaFunds.com, And then follow us on X and on LinkedIn if you're there too. Tapp Alpha Funds on X and Tapp Alpha on LinkedIn. Because as soon as we're able to talk about them, we're going to put out information on the next stuff that's coming through. So just know the input that we get from the retail community is so important to us. We listen and we take action on it, and just know there's some really exciting stuff that's coming down the pipeline.
Okay. I don't think this necessarily impacts, Edgar filings or anything. What day are you thinking about doing the distributions?
Not sure yet. Our current two funds are basically Monday declaration, Wednesday pay date. And so we want to make it fit in that from a weekly structure perspective. So we're figuring that out as we go. And then, as you know, we're talking about off camera, we're partnering with Tuttle Capital Management on some of our future stuff. So we'll talk to them and get their strategic input. I'm curious from your standpoint, if there is a particular day that makes more sense from a retail perspective.
Well, the whole reason you changed your day was because of my quadratic formula, which I got everyone to work on, and it seems to have worked. Everyone seems to have benefited from it significantly.
It's nice, like the thing that you sort of like educated us on was that if you distribute on a Thursday, some of the brokerages don't actually get you the resources until end of day Thursday, and so you only kind of have a day on Friday to put it to work. What if there's a 3-day weekend and there's no trading that day? So that was one of the core reasons, the why behind it, why we wanted to move it earlier in the week.
Yeah, like if you pay on so your funds, they pay on Wednesday. If you hold your funds in Robinhood, you're not getting paid till Friday morning.
Yeah.
That's crazy.
Yep.
Whereas like Schwab would pay, Wednesday morning. E-Trade pays at night. Some of the other ones trade like Webull in the middle of the day. But a lot of these retailers who are buying these don't get paid for like days later.
That's bananas, because the exchanges like are required to distribute it on payday, and a lot of them can do it earlier in the day or later in the day. So if like the brokerages are holding it, there's probably a reason for it. And I mean, every day that extra $100 million is sitting in a bank account generates a lot of income.
I don't know if you were on there. We just had the webinar, Why Covered Calls Suck. And Matt Tuttle actually brought it up. He goes, I don't understand. And I actually have to explain it to him, why people are trying to scalp. And it's for that reason specifically, like if I can buy the morning of the dip, the morning of payday. And I know that as everyone else reinvests, it's gonna start slowly going up throughout the day because all the other brokerage houses are starting to unload their shares. People are buying in at the higher prices, and it actually becomes like an arbitrary scalp, if you will.
That's interesting. Yeah, I've seen the dynamics where drip. So like if people have a drip button pushed, as soon as those distributions come out, they go right back in, and then that might drive a little bit of the intraday premium or discount. It really depends on volumes. So like for us, it hasn't been like too big of a factor. Our biggest price influence is what's the underlying doing, but there is a little bit of something to get if that you can kind of pre-track trading volumes based on distributions. That's interesting.
Yeah, I actually when I had ran my formula probably about a year ago now, and ended up adding about 2% annually to total return.
Wow, that's big.
It was pretty significant.
That is wild. Interesting. All right. Well, you heard it first here.
Yeah, because a lot of the retail traders don't want to use the older firms. They're clanky. They're not like their UI isn't that great. It's very black and white. It doesn't have like a nice green screen background, so they don't want to use it. But they're losing a lot of upside.
I mean, 2% of potential total return actually becomes now the cost to be on these other brokerage houses, if that's really the case. But usability is important. You can probably get some benefits, especially mobile, right? Everyone's on mobile now. If you don't have a good mobile experience, it's really tough to do the trading and look at it from that perspective. But 2%, that's a real number.
It was significant enough for that, and that's why I kind of got everyone on board. I said, if you guys all do this and you separate it out, you're not fighting for space. People can get paid on Monday or Tuesday or when. and whatever, and everyone benefited from it significantly.
Very cool.
Um, where do you see the market? We have, the unemployment rate creeped up this morning to 4.6. We have a next Fed president. We have the yen carry trade coming in, I think, Thursday, that they might raise rates. Where do you see, like, how do you protect the market coming? Are you looking at the VIX right now?
Yeah, VIX is interesting. 16 and a half, 17 today. When I started doing this strategy, I did it in 2022 into 23, and VIX was like 12. And this was still able to actually generate meaningful income. So at 16, 17, it's really nice. And we do a balance where we don't get greedy with the amount of premium. We trade some of that in for more headroom and more protection on where we set our strikes, but as long as we're hitting our goals to make sure that we can support our distributions. But for us, like in any of those markets, it's been really nice. Like even when the VIX elevates into the 20s, like the premiums are astronomical. So you can buy more headroom and actually create the safety you need. Plus the other tools that we have actually given us a really nice like visibility tool into what the markets are doing. So for these strategies, like VIX goes up, it's good. VIX goes down, it's good. The main challenge is really if there's a massive upward rip. That's when you, in a short amount of time, that's when these strategies have a challenge keeping up, as evidenced by April 9th. The defensive tools are sort of our best bet to do it, but the market had a good run this year. There's some interesting macro trends that we're going to see end of this year and into early next that will kind of carry the market in one direction or another. I listen to a lot of like the big wirehouse analysts and kind of what they're saying. And really the market environment for when it's like choppy or a little flat is really good for covered call strategies. So, for me, I try to stay out of the business of predicting. I know you can't predict the market. You can just mitigate risk and react to it. But the tools that we have in the funds that we're running will be really good. And I think, hopefully in whatever the key markets do over 2026.
Where would you like to see the interest rates? Where are you on the side of the coin?
So it's such a hard thing because interest rates go down, equity markets go up. We love to see that. But one of the challenges is we don't want to actually reignite inflation. So, some people, Jerome Powell, for whatever reason, is a polarizing character. I've really liked him in the room because he's just been a voice of calm in a chaotic environment, and we needed that during this last year. We'll see if Hassett gets the call for next year or not. And if he does, interest rates are going to go down, and they're going to go down fast. So I feel like the wait and see approach has done a really good job to stabilize kind of the two initiatives for what the Fed is supposed to monitor, jobs and inflation. And I feel like that cautious approach is proving itself out in what otherwise would be a very turbulent market since what we experienced with the tariff policy changes. So I think interest rates will come down. I'm happy with the wait and see approach, the data driven approach. And we manage our strategy, like it directly impacts how we manage our strategy because that decision days, like you don't want to like put a covered call on in the morning because you don't know what's going to be said. And if the market shoots up, you could get in real trouble. So we're very cautious about not predicting the market. We're just trying to manage the risk around it.
Are you using flex options?
Not on this product. No, we're exploring it now, actually, flex options for future stuff. The reason we would do it is if there aren't shorter dated exchange traded options on a particular underlying security. Right now, we're kind of aligning more to, being a zero DTE overlay on existing indexes. And so there's 3 and potentially 4 now. The Russell has them, QQQ, NASDAQ 100 has them, and S&P has them. And then SIBO just put out a Mag 10 product, which may have a zero DTE exchange traded product pretty soon, maybe in January, February. So that's sort of where we're more focused is zero DTE overlays on existing indexes.
And what do you think of the NASDAQ just filed for like 24-hour round the clock trading? How is that going to impact you? That's going to be exciting.
It's exciting. And I think really at the end of the day, it's more income opportunities. So the question originally in my mind was like, oh no, it's 24 hours a day. So there won't be like a deadline for an option. But an option will always have a time of day deadline. And right now we're using the ones that market close every day. But there'll be overnight options that open, and they already are, that open at like 8 p.m. and close about 45 minutes before the market opens the next morning. So like we could in theory do overnight options harvesting. The challenge there is there's just so much, like 66% of the time markets go up overnight. So like you got to be really careful on capping that. But there's just more income opportunities with that change.
What is the volume like though?
Right now it's very low compared to like during the day. So fills and liquidity are really important because like, so for the viewers, if volumes are low, spreads get wide, and that cost is carried forward to the fund performance. So you just have to be careful to make sure you've got enough liquidity to support the positions that you're trying to take.
Yeah, that makes sense. Are you factoring in the yen carry trade at all?
No, no, not really in our purview. We're really just focused on we just manage the strategy daily. We're just writing daily overlays on what the S&P does and what the Nasdaq does.
And you're just so are you writing the option first thing in the morning, or are you waiting till like noon time and seeing if we change direction? Like what's your sweet spot?
It's dynamic, so it depends. So our sweet spot is really data driven. So we have a ton of data inputs that come in first thing in the morning. And for example, if the momentum is bearish and the volumes are kind of average, and it looks like, okay, the market's going to be relatively flat or maybe bearish coming out of the gate, then we'll take a position right away because we're trying to maximize theta decay. But if the momentum's up and it's cooking, like why would we put on a position at 9:30 at the open if the market's still going up? We kind of wait for the data to simmer. And once it's like simmered, then we'll take our spot. So it's really dynamic based on tons of real-time data that we pull in from the market.
Yeah, so it's really a wait. And you said you have a bot doing this, or are you doing this?
We have a fintech solution that's doing the data pulls, but
Yep.
what the fintech solution does is it pulls it and it surfaces it to me, and it gives me just a very simple view to say in the strike zone, out of the strike zone, and what's the risk reward. And then I can just, as the portfolio manager, say, yep, now's the time to go. And in the future, we'll automate some of this, but right now it's really important to have a human that makes the final decision. And then we can take all those decisions that we've had since we launched the funds, pump it into the AI, and then have it start to give us recommendations as we move the technology forward.
Awesome. All right, and this is the last question. I'll let you go. Bitcoin has been insane. It seems like when Bitcoin falls, it pulls the entire market. It finds it's like, it's 80, 84, $87,000 cap. And then when it rips, it also pulls, well, like, why is Bitcoin pulling the Qs, not really the S&P, but like the entire Q system just, tags along with it. Why is that, you think?
Some of it, well, it's interesting when MicroStrategy was part of the big indexes too. They became sort of a Bitcoin proxy, but they were wrapped in a software company. And then they had a challenge because Bitcoin became more than 50% of their total valuation. And so they ended up getting pulled off some of those indexes. So there's a direct correlation to some of the corporate treasury strategies. But here's the thing, the big change that happened with the administration that came in. The biggest risk for crypto and Bitcoin was regulatory. What are the regulators going to say? And before, it was a really friction and fraught road to actually bring it to the mainstream. Since then, everything's changed. Now there's ETFs that can encapsulate Bitcoin, cryptocurrencies. There's treasury policy now that's doing tethered funds into cryptocurrencies. So the policy environment has completely changed. And now you're seeing cryptocurrency actually like seep into the financial system in a big way. 2 weeks ago, Vanguard is now actually allowing crypto and digital currencies into their ecosystem. That is a huge tide shift from an asset perspective and a philosophy perspective. So you're seeing it kind of seep in to the foundations of the financial system. And once it's in, it's going to be almost impossible to get it out. So I think long term, it's here to stay. And you're seeing, I think, some of the price, over time will reflect the regulatory stability that we've actually seen these policy changes support.
Mm-hmm. Mm-hmm. And you guys are you guys ever going to dip your toes in the crypto sphere? maybe do the Ether or Bitcoin spot or
We've talked about it. Part of it for us is like it's lowest hanging fruit. So like our sweet spot are like growth plus income investors that are sort of low to moderate risk that want both of those things in just a calm, collected sort of way. And when you start to get into crypto and alternative stuff like that, you don't necessarily, you're not appealing to the same group of humans. So like we're focused on this group, but over time, as Bitcoin becomes more of a foundational thing, like yeah, one of the most attractive things about Bitcoin is the volatility. And as an options related strategy group, there's so much premium to harvest. You look at it and you're like teased by it. But at the end of the day, we've got to stay focused on the thing and the people that we're trying to serve. So that's a long-winded way of me saying not now, but maybe. And then we're partnering with groups like Tuttle. Tuttle is really innovative in how they think about product development, and they've got a couple products that are in the space too. So like we'd rather partner than compete with groups like that because they're sort of a core company that's helped us sort of get on our feet since we started. So Tuttle's doing a great job on that stuff. We're over here. We don't have overlap. And then when we do partner on stuff, it's this Venn diagram of like what we do best, which is zero dated options, and what they do best with things like leverage or creative applications of it. We can find ways to get common ground there. I think that's the way we would enter some of those markets.
well, that's awesome. If you had to look forward to, I don't know, what are you looking forward to most in 2026? Like what
I'm looking.
night?
Well, so what keeps me up at night is just April. It's like, are we going to have another April where VIX spikes and there's just a lot of jiggling in the markets because that just makes it a lot more challenging to manage these strategies. We are much better equipped with some of the stuff that we've codified to manage through it. But like, I mean, April hurt just going through the process and like we were just getting on our feet as a fund and we had maybe 20 million in assets back then and every dollar mattered. And then when the markets drop 18%, your AUM goes with it, whether you have people pull it out or not. So just getting stability in the markets, I think, is one of the most important things that we have no control over. That's the kind of stuff, the stuff that like I can't put my hands on something and take an action. That keeps me up at night the most. So fingers crossed we get stability into 2026. Markets stay, manageable, and we've had an incredible run. The AI productivity component and why like corporate earnings have just been astronomical is real. And like I can say it from an anecdotal perspective. When we started Tapp Alpha, October of 22 is when I started doing this stuff. Guess what came out in November? ChatGPT. And so we've been using it from day one, and it has helped us build everything, all of the fintech underlying components that run the funds. Like I have a computer engineering background, but it would have taken me forever to develop what we developed in a fraction of the time. I thought I would have to get two developers, a product manager, and all these people to get this thing together. I was able to do it on my own, nights and weekends, to build a really robust system that's now changing the efficiency that we can actually manage over $215 million. So AI and the productivity gains are real, and we're going to continue to see, I think, growth and higher profits over 2026.
Two billion's next. I see 2 billion.
Baby steps. Baby steps. Yeah, I can't even get my head around that. Like being able to say almost $250 million in 11 and a half months, like that is mind blowing, but it's really a testament to like DIY investors that are getting educated. They want to understand, they're smart, and they're seeing opportunity where it takes a minute to learn about it and figure it out because you got to look under the hood. That's really, I think, the tailwind that we're catching now. And the content that you provide to folks, the education that you provide is a really big reason that there's tailwinds like that in the ETF industry, especially for retail investors.
And it's something we've never had before. Like I'm going to chop this up into, probably 32 videos and it's going to go everywhere, which is something I started doing.
So that's the coolest thing, right? Think about the reach that you have now. You've got content and you can actually get to people in scalable ways that you could never do before. But like that impact, and then the idea that I love about communities like yours, it's we can do this together. like we don't have to go through this adventure alone of how to invest, how to get the outcomes you want. It's a shared experience with others that are like-minded. That is so powerful, and you can do it at scale now. This is honestly, this is the most amazing time to start an independent business like yours or doing what we're doing. There's never been capabilities like this for individuals to create value in the marketplace like today.
So thank you so much for coming back on. Let's do this again in January. I know you're coming on the Financial Heat podcast. Maybe we can get you to. Are you going to ring the bell again? I saw your picture ringing the bell.
Yeah, and Matt and Pete and those guys came too. So we'll see what happens based on product launches. But stay tuned. January should be fun, and let's definitely touch base in the new year.
Okay, and people can find you on where?
TappAlphaFunds.com is the site. You can sign up for our community, our newsletter there. X, Tapp Alpha Funds as well. And then LinkedIn, Tapp Alpha. Those are the best places to come. Stay in contact with us. Give us feedback. We love to hear from the communities out there to understand what challenges you're looking to solve and if there's ways for us to help you solve them.
So, do you guys have like hats or any gear or anything you're sending out to people?
I love that. So it's so funny. We just had a strategic offsite. Swag is on the way. So stay tuned and we'll have some good stuff in 2026.
And they should where should they email you guys if they want to get in the wait list?
TappAlphaFunds.com. There's a newsletter sign up right there, and then we can get you on the email community.
So thank you so much. We'll talk to you soon.
Yeah, thanks for having me.